I share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to go through the setup for the week. We're going to talk about some events that I think that were important that happened last week. So let's get into tonight's video. Well, welcome everyone. Yeah, I know it's another late start Sunday night. It's right now just about 11 p.m. Eastern time. So we'll see how many of you folks are up, and hopefully you'll get a chance to watch the replay. Anyway, we had an interesting week last week, and I think one of the things that I saw and we all saw was this revision in the employment numbers. 800, and I don't have the exact number, 836,000 overstated in the employment numbers. And so a lot was drawn from that, at least a lot of chatter around it. And I believe one of the things that everybody kind of came out with is, are any of the numbers that we're looking at now have any validity? In a minute, I'm going to talk about the reports that are coming out this week. But, you know, there's an old, I'm an old dude, so there was an old commercial, I think it was way back in the 80s. It was Memorex tape. It says, is it Memorex or is it real? We don't know what's real anymore, just about on anything that we do in life right now. Media seems to be corrupted. Everything seems to be corrupted. And even we saw last week an amazing incompetence. Now, they do this audit every year. And last year, it was a fairly big number, like 174,000. I'm going off memory here right now, but it was a small number. It was 5 or 6 times bigger. So what actually caused this? Was this just completely incompetence? Was this cooking the books for the elections now that Biden's blowing up, and now they're gaslighting everybody on Kamala and everything that's happening in the world? I mean, what amazing thing on Friday to happen here in Arizona with RFK coming out at the for Trump. It's pretty amazing, I'd have to say the least, that a Kennedy is endorsing a Republican. That's how messed up the Democratic Party is right now. Anyway, what we saw last week in these numbers, though, really bring up a lot of questions. And I've argued in the past, and you've heard me say this, is that a lot of times what we're seeing is these numbers, we know they were cooking the books. They almost always do anytime, and that's that overstatement, especially in an election year. But no one can imagine they were as big as they were. I saw estimates before the review came out that it was going to be over 1 million jobs overstated. 860, whatever the number is, 865,000, whatever it is a very big number. And so a lot of folks started extrapolating out, okay, well then the economy hasn't been as strong as it was before. So we saw the markets went up right after this came out, right? So they shrugged it off. The next day we got the reversal pattern that we got out of nowhere, and it went through some of the extreme numbers that I put out on the Substack newsletter, and then we bounced right back on Friday. Here we are again. We ended up the week, I think, around 1.5% on the S&P, and the Nasdaq, I think it was 1.4. The big one was everybody jumped back into the Russell again. It was up 3.6. I'm just looking at my notes here. Yeah, 3.6% last week. And so they're about to sucker everybody into slaughter number 2. Those, I don't see the Russell just taking off and going into a big bull market. I'll cover it tonight. So the plan is, I see a question here, and I'll look at that, Tony, just in a minute. But all of these numbers and stuff are coming out. We're going to have to really question them. There is no third party that we can go to. So what we have to do here, let's just try to tie this down. what we're going to have to do with all of these economic numbers is we're going to have to see how the markets respond to them. Does the market become, market participants start to shrug off just about anything that it comes, and we start to see rhetoric around the release of numbers that, are starting to tell us that nobody believes in anything anymore. Everything is the tooth fairy and all that. It's going to be interesting because we have, let's talk about this week real quick. Let me bring up some of these reports, but we've got GDP revision coming. That's at 2.8. You don't think those books are cooked? Of course they are. We'll see if they adjust those, if there's any. I talked about this, I believe, in one of the Substack newsletters, that we get these seasonal adjustments. And that's how that usually hides behind seasonal adjustments. So otherwise, they've got an algorithm or something that they're using just to estimate what things should have been. I've never understood the reason for seasonal adjustments. Otherwise, they're adjusting them up or down, and they're trying to get some even flow. So let's face it, everything that we see is being manipulated at a very high level. And so I'm just looking at here, we've got FHA housing prices coming out, Case-Shiller coming out. That is on Tuesday. We got durable goods on Monday. But the big numbers that we're going to watch for is the GDP. I was just talking about that. It's interesting. Second estimate, a lot of folks don't see this as a big number. It's going to have some impact because the algorithms and everything are going to be responding to these numbers when they come out, even though they may not be that impactful. Then, of course, we got PCE numbers coming out on Friday. That's probably the big event for the week because the inflation story's still out there. So I'm going to go back and let's just go back for a second and talk about not only those numbers, Powell's address on Friday. Everybody's extrapolated out that they're going to drop rates in September. Maybe that's the case. The fact that Powell's saying that it's time to consider to drop rates, maybe that means something. I think that it's so built into the market, even if it does happen. I'm still kind of 50-50 on that number. But I think what we'll see here from the standpoint of the reaction to the markets when we do get to September is almost not quite 30 days. I think the meeting is on the 27th of September. I think it's late September. And I still think the Fed is going to want to stay neutral as far as the elections go, but we'll see how it plays out. I don't think it's material as it goes. So let me just look at something here. Yeah, so Tony, I'm going to go through the database. So I just saw your question here. I will go through that. Yeah, we're going to go through Russell and in NVIDIA on Wednesday. So I'm hoping, folks, that it might have to be late at night when I can do these things. This may become a little bit of a pattern and try to keep things down to maybe quick updates during the week. We'll see how everything plays out there. But the realities of everything that we've got to look at as we go through this week is these numbers are just, in my opinion, have always been questionable between the seasonal adjustments and all the fudge numbers that are out there. There's never been a lot of validity, but we live in a different world now than I grew up in. I've been in the market since 1979, and I've watched things change a lot. And we have actually what I'm going to call is a new class of investors out there. The largest investment group out there is still obviously institutional, but the next in retail has become quite big, and the millennial force out there is quite substantial. And these guys get FOMO, whether it's up or down, and the markets get pushed really hard, just like what we saw the other day where the market started selling off and everybody piled on wave after wave. I've talked about the swarm or this big herd trade that goes on. I've definitely seen some different configurations in the markets. So any of these numbers may seem insignificant, can cause a trigger of that sort. And so volatility, I suspect, will stay reasonably high. We've seen a bit of it expansion and all that. So let's set up for the rest of the night. I'm just looking here. Late night is the best. I like that. Yeah, I mean, we'll check out all of the futures here, but let's go ahead. I'm going to answer Tony's question, and we'll go through the database here just real quick. Listen, folks, and just literally when I get done with this, probably I'll take an hour and a half break, and I'll write the Substack for tonight. So if you're not getting the Substack, get that. It's kendallreport.com/newsletter, or you can go to kendallreport.substack.com. It's now $20 a month, but if you get an annual, it's $12 per month if you get the annual subscription. So I appreciate everybody that already has subscribed. I believe there's around 2,200 right now. So I'm very, very happy with that. I've put a lot of effort into the newsletter. So let's go in and let's take a look at the database here. Couple of interesting things here on the database from this standpoint. This is the intermediate, and it's now at 69.98%. And the question that Tony had is comment on how you take an account for the buy signals in the database between bonds and equities when you consider the strength of the market. So I actually just look at it as a whole. So if there's looking at it as a cash flow, so I don't separate out. We used to have another database we ran. We're working on getting it up and running. That used to be on portfolioexpert.com that broke things out by equities versus bonds and all those things. But I think that So just so you know, we're working on a project right now. I see somebody is on a tight budget. We're actually working on a rent to own for the indicators, and potentially a subscription basis for the indicators as well. We've been working on this project. IT guys are been working on it. We're pretty dang close. I'm hoping that by the end of this month. So we're going to try to get this out, because we've had a lot of people tell us they want these things, but they just can't afford them. So we're trying to get some kind of way to schedule it out. I think it's 16 months pay schedule for the rent to own, something like that. But anyway, we'll be talking a little bit about that as well. So you can still go check out kendallreport.com/indicators to find out more. I've got a number of projects that I'm working on. I've had some scheduling changes and things that were going on with me personally. So things just freeing up a little bit, at least of being able to focus a little bit more. So let's talk about the database here. So we had, as we look at it, we had 900 new buys on intermediate, 89 sells. So we pushed the bullish percent up to 69.98. And this is amazing, because you folks know, and especially if you're reading the Substack, every week I'm going, we're going to drop below 62, go into the 50 handle, all that kind of stuff. And we just we didn't do it. We stayed right at 62%. Now we're pushing up 69. I've got a note here on that we're probably heading up into 72%. We're getting new traction. Not only that, we got a new sector participate. We had 6 sectors long. Now we've got consumer cyclical kicking in here as a new buy on a sector basis. And so we're still seeing traction coming in. So very impressive, folks. I have to tell you, I'm going over here to the short-term database, and right now it's at, which is amazing, 72.49%. And we had let's see here. I'm going to have to rough number this, but it's about 1,450 new buys versus about, we'll call it about 95 exits. So very bullish ratio, especially on the 1.2. It's got a 20-to-1 ratio. So this is still very bullish from the standpoint of what is going on here from a database viewpoint. And as you know, I always say I'm data driven, and this is the case. So what we're seeing here is just more traction. I mean, I remember there was somebody even on a YouTube channel or on Twitter back in January of this year. I said we were going to see a decent rally into at least July and possibly October. Well, guess what? Here we are in August, and we saw a recycling. We basically got a big rotation. And one of the most interesting, I think it was about 2 weeks ago, we had this big buy and sell tranche on the 1.2 model where it was like 1,200 buys and 1,100 sells. Never seen a ratio like that. It was almost like a bunch of stocks got swapped out for one for the other. And I've watched this database every day, every week for decades, and I can't recall seeing that type of activity. And I've been covering this in some form or another, like my institutional accounts knew from, I would write basically like the report that I'm writing now every night in behind a firewall. So yeah, we could. So let's see here, folks. I guess I'm impressed. We've got almost 200 folks up late at night, so we'll try to get through here. We'll do a fair amount. We'll go through this as always, folks. This is totally unscripted. I have some notes that I do, so I'm just kind of going to walk through. We're going to go from the database. I'll go to the S&P and NASDAQ like I usually do. We'll bring up the interest rates, and we'll bring up some yield curve stuff. I think it's worthy of talking about. I've spent a fair amount of time talking about what is going on. Yeah, I'm sure there's a lot of layoffs in California. I'm just looking at a couple of notes here real quick. Yeah. Okay. I'm just reading a couple comments, folks. Just give me a second here. Yeah, you're probably right, Tony. It probably was a bunch of bond funds that kicked in. That's probably exactly what happened. We also saw, one of the things I didn't talk about. I'll come back up before we go. One of the things I didn't talk about is we did see housing bounce back really good last week. I mean, we saw new sales and homes just pop pretty good last week, just on this drop in yields. And everything's starting to rotate. It's very interesting because I think that one of the issues that we see constantly with the economy and everything is that we're getting this amazing dynamic rotation. And been a long time. I'm trying to flash back. There was a time back in the 80s, and even though we had expanded inflation well into, I think it was 86, 80, 87, even coming into the 87 crash, there was still an elevated inflation number out there, even though Greenspan or Volcker did a good job at knocking things down. It still was very elevated. And we saw, it was interesting because it was sort of like this. I was flashing back, trying to think about things. And I remember there was a cycle that we just kind of kept going. We'd get a little bit of a pullback, it would refresh, and then we'd start into another run. And that's what we're seeing here. And, it's as long as you got as many people out there that are talking about the potential for a market crash. I mean, even Trump's throwing that around as a market crash. I don't see the evidence of it, not from a technical and a quantitative basis. And I would tell you that the experience that I have in dealing with our database and dealing with all of this stuff is very robust. We've had the database around since 1998 is when we first produced the WaveTech portfolio management tool. It was called VPM at the time, Virtual Portfolio Manager. But I've been watching this database for decades, and you know this it we the .com bust. We started selling in February, March. Market rolled over big. We were out of a lot of stuff. I can go through all the cycles, but it's very good at picking up these cycles. Even coming into the pandemic, we saw monster sells coming in January and early February, and I wasn't. You guys didn't know me then. I didn't really do anything, have any retail exposure at all, and I was getting calls from my institutional accounts going like, Bob, we're getting all these sales. What's going on? And we were right at an all-time high at that time. So it was interesting that all of a sudden a lot of these trends started to break prior to the whole lockdown and everything that we went through. And it was basically an implosion, as you know. And that was we didn't miss that, and the rotation has been very solid. So I've got a lot of confidence in this, and I get people telling me all the time that the database lags and it's wrong. Well, it's not. It actually has a lot of forward-looking expectations. So anyway, I will fine-tune a lot of the stuff I'm talking about in the Substack. So let's do this. Let's go into the S&P here, and we'll take a quick look at that, and we'll touch on a bunch of stuff. So this is actually Russell here. Let me just it's interesting because the little red dot indicator, this looks more dramatic. This thing's going to flatten out. If you look at what's going on with the algos, with the moving averages, they're starting to flatten out. I'm hoping that everything will work so I can draw this in. It looks like everything's good tonight. But yeah, so we got this big move down, right? So we get this like three-wave move down, and then we get this vertical move up. So, and it looks to me like this is what I've been talking about on Substack, that we're going to come back into these moving averages and possibly set up some kind of flag. Whether this will probably be real obvious. I'll bring up the WaveTech webs here because this will be able to define this quite good. Let me just let me close this out. See if I can bring that up here. Yeah, these webs, we're starting to get some crosses here. This is typically, we'll start to get a pattern that sets up. Like I said, we should come down into the moving averages in here. I don't think we could stay above the 10 and set up another run. But I think what we get here is a definite consolidation. Now, if we go back just a few days ago, folks, and I've been talking about this for a while, is that we're looking at, we had this 8-day run up. Now we have 1, 2, 3, 4. This is the 5th day sideways. So we could complete this if the key that's going to be important to watch is to watch this low over here at let me get a number for you, 54.82. this low, if we take that out, then we're going to challenge this 10 period moving average. And like I said, I think we come down into the 40, into this pattern here. I think that's where we ultimately get to. Let me just draw that in so it's clear. Is we should start to see this come in just like it's being projected on the algos, but I think it comes down into here, and we have this rising 21. I'll show you the PPMs here in a minute, and we should see kind of a wedge, and the market should start to actually just move in here all together. Let me get rid of all this. Yeah, this should just come right into some kind of pattern that we get like this, right into some kind of, this is what's being projected. I think this is how it'll play out. It's possible that we get another run. The all-time new highs over here on the left of the screen were, I don't know, I think we're less than 0.5% from that level. So that's certainly a possibility from that standpoint. But I really think that what we're looking at here is the pattern I just have drawn up. And let's go and take a look here from and let's go over to a weekly chart here real quick. So you'll also see weeklies have turned down. The volatility is flattened out. Let me bring this up here so you can see it. This is really typical. I'll draw in just a couple more things. This is going to follow through. The theme that I'm talking about here will follow through with the other indexes as well from the standpoint. But we should start to see the market grid start to contract. And this is weeks, right? So ultimately what we're going to get is the markets are going to end up coming into this range here. And we start to trade in. You can see there's still upside being forecasted here on the algos, but I think ultimately they probably come in here and flatten out, and we will just stay in some kind of range here. I don't think this is the pattern that we're going to see from the standpoint of everything that we're going to just get a moonshot here. It doesn't appear that fundamentally there's not going to be anything. Nothing's probably going to happen before the Fed meeting. We've got the election. There's way too much uncertainty to make a run here. Doesn't mean we can't. It just probabilities would appear from my viewpoint that we're not likely to get through that level. So this would be probably from a standpoint here, we probably get some giant pattern, something like this. And this, meanwhile, like I said, the market grid is going to contract. And whenever we get, I've talked to you folks about this before. I've talked to you folks about this before, where the market grid, when we get an expansion of volatility like we've seen over the past several weeks, it takes multiple weeks for it to contract down, and typically, not 100%, but typically this volatility will collapse. There's a lot of work and consolidation needs to be done before the setup will show us the next directional move, okay? So that's what's set up here on a weekly basis. Let me just bring the PPMs up and we'll do this, and then we'll touch on, yeah, so PPMs you can see are still kind of reasonably not negative. They've got positive integers, but the patterns are suggesting that we're just kind of peaking out here. And even the red dot close indicator is there. And by the way, if you have the indicators, you have this thing. People have asked me, how am I doing this? All I'm doing is taking any of the WTI forecasts, and you're just turning the projected period to 1. And then the only other thing I do is I change it. I make it a fat bar so I can see it easy. Do whatever you want with this. Leave all of the settings, the coefficient to 150. Future bars I put out for 14. It's probably good for 2 to 3, to be honest, but it's kind of interesting to see how the pattern is being forecasted out, and then increments of the coefficient and the increments of 3. All these settings stay the same. So you have the indicators, make sure that's all you have to do here to get that how that looks and get the same curve. So let's go ahead and let's go to the NASDAQ next. So we'll go top down, which means we'll take a look at the weekly. If you notice, the NASDAQ is really flattening out a lot here from the algorithm standpoint, and the moving averages, if we look out, all of these projections are really kind of sloppy, and we're already starting to see on the NASDAQ the contraction of the market grid to a point. This is going to take, by the way, probably 3 to 5 weeks for this to happen. This is going to carry us into September, end of September, maybe even into October before we get this event actually over with. So to be getting bullish here, I would be individual stocks is a much different thing than looking at indexes. So the index is really just looking at a stable period and all that from that standpoint. So let's, but you can see how the algos, I've just brought the PPMs back on, look pretty flat, a little bit of a rally looking at a forecast mid-September, maybe towards the end of the month. Probably, guess what? The Fed meeting's right here. This is potential for some kind of rally when we come into there. We'll see what everything looks like. We're a little bit ahead. Let's take a look at the dailies. And I'm just 32 minutes in. I'm trying to keep a track here. Got a lot to cover yet. Well, should accelerate out here pretty good though. But I've left the webs on here for the moment. Let me take them off. Clean this up just a little bit. But you can see here on the daily, same type of forecast. We do our forecasting for really higher, but if you look at it, we're forecasting within the market grid. So nothing, if you recall how these dots are looking, I post them. If you have Substack, I think I enabled it so you can go back for a couple months on the Substacks and read some of my old newsletters. If you take a look, I post this chart every day on a daily. You'll be able to see that the forecast, if you go back 8-10 days ago, it was vertical forecast. So it was very accurate from the standpoint, but we've been seeing this for probably 2 or 3 sessions now. I've been talking about the market stalling. A lot of times you'll see the headlines when I come up with a headline for Substack, and the same thing here. Will a top be signaled this week was the name of this video that you're watching right now, this live stream. So we're really not looking at a major top, but we're looking at the market starting to stall, a broader consolidation, even though we're seeing the WaveTech database expand, all those things. All that tells you is the underlying trend is still very solid. And typically we don't see big rollovers, big declines in the markets when the database is over 42%. I showed you we're almost 70%. So what that means is 7 out of 10 symbols in the database, they could be bonds, ETFs, or individual stocks, are very, very bullish right now. There's very robust trend going on. So, but this is pretty typical. If you look at the daily, it looks like that as we come into Tuesday, it looks like PPM1 is going to signal a breakthrough, the first derivative, which what that tells you is we should challenge the 10-period moving average. We're pretty much right there right now. That's 19,617. We're trading 19,754. So we'll call it 19,600, probably a break below that. Then we come into that same moving average range that we talked about before, where we see a decline into the 21, 40, the lower average is in the pattern, which in this case is the 21, which is the same on the S&P. All right, let's go through the Russell here. So I brought up the Russell cash on a daily. You see it just spiked up. We still have some more positive. I think the stampede is on again. This decline, when this market failed up here, I wrote in the Substack newsletter that this was a distribution top. So let's break this down and let's talk about what this was really all about. So this little range right here, hang on, let me get the right tool. So this range right here was a distribution top. And what I was talking about in the newsletter was that it would see a collapse down, I thought, into this range. Well, we went and we even took out the June lows here, and now we're rebuilding. It's like playing Jenga. Okay, this was a collapse, and now we're getting this move back up. You can see the indicators this is probably the most interesting one here, is the longer term. You can see the moving averages are still internally collapsing. We're not in what would be considered a trend mode, big trend about to come about. So Tom Lee is not going to double his money here, okay? Matter of fact, from wherever these guys, between Druckenmiller and Tom Lee, wherever they said to get long, they were getting long, they got punished on that trade, or getting punished. Both of them have a lot of money, so you can hang around. But this is just a rebound back into that distribution top. And we still have, you can see here that the PPMs still have a little more upside here. The dotted lines on these indicators are the forecast. That's the predictive math that's in the indicators, predicting what they're going to look like in the future. They change as prices change a little bit, but we also got an RTX sell signal, and I'm going to take this out and we'll go to the future so we can get a snapshot of what's going on right now. So let me just back all this stuff out. So this was the futures. They also got an RTX sell signal. So that suggests 1 to 2 days minimum of sideways. Sometimes we'll get a big move. In fact, I'll move my cursor over here up at the top right before this consolidation. We got one of these RTX, and RTX is when the market value closes above the market grid on the extreme. The RTX is the extreme projected for any day. So what's happening here is that gave us the 1 to 2 days, which led to a consolidation, which led to distribution top. And here's the thing. We'll talk fundamentals on these stocks right now. These things are still zombie companies. And the reason why I was screaming when we were at that top that we weren't going to break out, people are telling me we're going to all-time new high. I'm like, I don't think so. And the reason for it is we're not in a place where these guys are going to, these stocks that are in this index, which are a lot of regional banks, a lot of small banks in here. And it is time for the Fed to lower the rates. And I'll tie this together because we're going to go right to interest rates right after this, because they're very tightly tied together here. But what happened, these companies, a lot of these banks, the banks now need for the front end of the curve not to be as high as it is. That's causing CD rates and cost of doing business, and it's jacking up the balance sheet right now. And the inflation thing is over. They got a lot of potential, a lot of new assets to come in for the higher yields. But now from a banking standpoint and a cost internal, that you're likely you need to see that front end of the curve come down. So when we go through the interest rates, I'll go to the yield curve and we'll talk about that just a little bit. I'm hoping I still have a graphic that I made before. If not, I'll draw it up tonight for us. But the realities is that what we're seeing here is this is just a rebound back into those peak levels. Doesn't look like the algos are going to do this. A lot of what happens with the algos in this predictive math that we have in our indicators is it looking back over 150 days. So it's kind of seeing that what I call the echo sell-off. So we'll see what happens here once we get to these levels. We're basically back into major resistance, and from that level, we'll see what we get over the next couple of days. I think as we go through the week, we don't, like I said, I don't see any real material news coming out, but I'll talk about this in the Substack. And like I said, we may have some late night meetings. I'm impressed by how many folks that we're getting online at this time at night. So like I said, these might be better times for me to get live than any other time. So let's go ahead and let's go into and take a look at the treasuries, and then we'll do a yield curve. So it was kind of interesting just talking to you about these numbers. The algos are still suggesting here that we're going to see lower yields. And this is a daily chart that I have up here for you. You can see these downward slopes here. This is a huge trend on the downside. We got right here where my cursor is, we got an RTX sell signal just on, what day was that? That was Thursday's action when we saw yields pop up. The next day we were down, and then we actually got, looks like a potential STX buy signal. So I would expect that as we go forward here, at least on a short term, that we start to see a kind of event that looks like this, is these moving averages coming down are big time trends. And I'll show you the PPMs in a minute. We're seeing some flattening of the trend, and the algos are, I'll draw these in. This is predicting what yields. This is down to like 3.6, by the way, down here. So that's very low. We got to 367 over here at this spike low right here. So this is kind of setting up for maybe a retest of those numbers. But for the most part, this pattern is one that we are likely, let me clean all this up so you can see exactly what's going on. So this is most likely what we're going to see here. Yeah, so what we're likely to see here is a pattern that potentially is to look like this, and we're going to cap out around 4%, 390, and then probably somewhere down in this range here. So the market's going to start to stabilize here. This rally in the bonds that are happening is probably going to start to fade. We could potentially retest this low over here that I'm drawing an arrow to, and then we should set up more of a range type situation, which is going to be around 370 to 4%. I don't see us doing anything ahead of the Fed, and so let's take this stuff off, and let's see if I can get us. I'm going to get us over to the yield curve real quick. Hang on. I'm just trying to see if I have. Okay, unfortunately, I don't have the graphic I look at, so I have to do a new one. So let's do a quick Google search. I'll find these guys. Yeah, there's a website. It's pretty handy. It's called U.S. Treasury Yield Curve. What's nice, what I like about this is I can go in and I can go back and draw what the yield curve looked like, what the yield curve looked like back in December. So we can go to December 31st. So what's interesting about this is this curve that we're looking at is a little, we've seen yields dip down more than they were at the beginning of the year. And the inversion is approximately about the same. And so let's just talk about this real quick here. So my expectation is we'll start to see the yield curve come down, and I think we'll ultimately, we're at 5.25. We'll probably have about a 1% drop, I'm calling probably into Q1 of 2025. And then what we end up with is virtually a flat curve that I've been talking about this for a while. And what's going on with the yield curve here is actually a normalization of yields. And that we go back when they started this, I told you folks that what we're looking at here is a scenario where we're going to normalize yield. So on the back end of the curve, we basically have normalized. We saw definitely the tightening effect happen here with the front end staying up over at 5.25. I think effective Fed funds yields are hanging right around 5.33. That number needs to come down about, in my opinion, probably 2%. So 2025, we're going to see yields start to come down on the front end of the curve, but we're not going to see things change much on the back end of the curve. We're not going to keep the inversion. We're going to go to a steepener, and this is what it'll look like. So I'll draw that in. This has been my expectations, is that ultimately this is 3.5 over here, and we get some kind of deal like this. And ultimately, this is, draw this line here. This is like 4.25 yield. And then down here where this green line is, this range is around somewhere between 3.25 and 3.75, that range. And then everything will start to slope like this. And this is a normalized yield curve. So what the Fed, in my opinion, has been doing for a while is what they're doing is normalizing the yield curve. I am attempting to work on a project right now that I'm going to talk to folks a little bit about. Let me see if I can get back to where I was here. Yeah, I'm going to talk a little bit about what I think the Fed longer term is going to do. And so I'm hoping to get a video out on that sometime soon here. Let me get everything repositioned. But so the yield curve will probably start to drop. I think if the Fed does do a quarter in September, that's okay. But we need to bring that down a minimum of 1.5+% over the, I think we probably start to see every Fed meeting going forward is a drop of 25. I don't think right now they're going to drop it because there's a recession, but I do think this is what I was talking about with the Russell stocks. So I'm going to tie all this stuff together here. And this is, I think, important to understand, to tie all this together. The Russell has a lot of banks, and the banks now need the front end of the curve to come down, reprice the cost of banking, get a positive spread going again, and that will finally normalize. At that time, we're probably going to see the big rotation, which will be the Russell stocks start to lead in a bigger way. So while I'm not short-term really bullish on the Russell, longer term, I think they will start to benefit, and it's perfect cycle from the standpoint of the Russell, because what's likely to happen here is that these stocks will need to be refinancing a lot of their debt coming into 25 and beyond. And if that curve gets reconfigured like I just showed you, then everything is going to be copacetic. Everything's going to be fine. And this will be, we'll have to watch it. It's going to be like watching paint dry. So hopefully that was a good understanding of what's going on there. All right, let's go ahead and move on, and we'll go to, I do want to bring up one thing. I'm going to do the Dow. How late are we getting? We're 50 minutes in, so we're going to, as long as you folks are hanging out, I'm just going to keep going here. Hey, watch it about typical boomers. I saw that. Anyway, we deserve every criticism we get. I always say we went from my father being the greatest, I guess, demographic and ever been, to the worst. The boomers have been pretty bad, actually. All you got to do is look at Congress. You can figure that out. So here's what's next. We're going to take a look at the Dow real quick, and we're going to go through the Dow yen as well, because we're starting to see some interesting things happen there. Yeah, I guess, like I said, we went from the greatest generation to the worst. I mean, if you look at, we did some really cool stuff. I keep telling all the millennials that it's, you're going to have to fix all the stuff we messed up. Okay, so this is interesting. We're looking at the Dow. We got a STX buy signal, and I've told you folks before that the STX buy signal, which is when the price extends below the extreme, suggests a sideways to up for at least 1 to 2 sessions. It's not a big deal, but what it does is sometimes we'll set up a bottom in these patterns, and the inverse on an RTX. But the patterns that we're seeing here is the Dow is probably going to bottom here, and this is on a daily. Let's take a quick look at the weekly, because I haven't covered it for a while, but we're right on the 200-week moving average. Let's take just a quick look at this. You can see here the 200-week average. It's interesting because the algos are suggesting a collapse here, but I think what we're going to see is more of a pattern that rides along this 200. That's a pretty good slope on the 200, so I don't see that breaking through, but this is basically extreme. The last couple of times we've been anywhere near the 200-week moving average, we got a decent bounce. The algos are suggesting on a weekly basis and a daily that we're coming at least into a bottoming period of time. So I think the Dow will catch itself. So let's go ahead and go to the Dow yen. So let's take, this is interesting, is what we're seeing here. Oh, I got Australian Dow, sorry. I'm trying to get something the algos will run on. Some of these data in TradingView is kind of wonky. Bear with me 1 second here. Let's try this one. Yeah. Okay, good. You can see we're basically trying to retest that extreme that we got in the carry trade. And the algos here are suggesting that dollar is going to strengthen a little bit, but not as much as it is on the actual dollar index. And you have to understand that the dollar index itself has a very heavy weighting toward the euro. Okay, so it's overweighted to the euro. So when you're looking at, you start to break down, you start to look at individual currencies, you get a much different look from that standpoint. But I think this is setting up a right shoulder here for here. Let me draw this in just so we're all on the same page. And yeah, so this is really just a vertical move down, right? So now we get a little bounce, maybe something here, and then a pattern like this. And we've got this declining 40. What's happening here is we should start this is what I think we'll see with a 10-period moving average, and we end up trading in a broad sideways range here, and we're not really going to get out of that for a while. Should be a big consolidation. And this is not a negative. This is actually a positive because it keeps the Japanese from having to take any further drastic measures than what they've already done. And in fact, the opposite when when we got up to that 165 level, let's see what that number was here. Yeah, when we got up to 165, that was extreme. So now we've corrected it substantially. And this really is more of a safe zone than anything else. We could go back to where we were in the past from the standpoint of going back, just trying to get the data so it'll come up here. Yeah, going back into that 140, 145 range is really where we were back in 23. And then there was another dip there as well. I do want to, while I'm on this, I just want to, as I know there's folks that have talked a lot about this, but unfortunately, I'm trying to get a good, this database doesn't go back. Hang on. Yeah, I'm trying to get a longer database. Yeah, so this still is not real good. I had one that went back way back into the 70s, and if you look at where the yen used to be, this is really where the dollar yen used to be. This is really just a retracement rally. So let me look at some comments. We got quite a bit of activity tonight. Yeah, and I see Mick is quoting the first generation makes it, second generation spends it, and then the third generation blows it. Yeah, and then somebody else has to rebuild again. I had consulted a very wealthy family overseas back in the early 90s. I worked with them, and in a very large family office. And anyway, that's where I first heard that was from them. They realized this, and they were trying to avoid exactly what you're talking about there. Yeah, just look at a couple more here. Yeah, I'm not sure, John B. There was actually a guy on the moon. That's starting to be. I'm trying to figure out who's running those running those cameras, watching things take off. That's pretty funny. But anyway, but yeah, just looking here. Yeah, so Ed Forrest, let me address this. Confusing WaveTech big buys. Now you have to understand these are new buy signals on individual symbols. Okay, so what that tells you is there's a rotation coming on. We have symbols that are longer in the tooth that have already made a fair amount of profit, and now we have new symbols coming in. They're still holding on. So what happens? The database, when I talk about a rotation, what will happen is the next phase is those old trades will come off, the new trades will stay on, and then there's a very large rotation, especially the typical holding period on those intermediate signals that are out there are about 1 year, about 240 trading days. So a touch over a year. There's roughly 220 plus days in a trading year. So what happens is the fact that it's getting more bullish is just showing you that there's underlying strength coming in. So that is actually the support. There's new leadership that comes and rotates into the market. So if we were to, and this is something I'm actually working on the database, that we can go in and not just look at the pure signals, but actually get to the point where we can actually get an idea of the rotation a little bit, and we can look at that right now as well. But I didn't go through that tonight. But if you have WaveTech, if you don't, maybe I'll bring that up in the Substack tonight. Yeah. Anyway, yeah. Funny thing happened to me too on the way to the moon. Okay, let's. I'm just looking at some comments here. There's quite a bit of stuff going on. Yeah, I'd love to talk about the hydrogen fuel cell. I don't think the fuel cell is the. I think it's. I real quick. I'll just make a comment from William. Said something earlier. I don't think it's a fuel cell that is going to be a winner because you still need a battery for that. I think you're just looking at a hydrogen piston engine that doesn't need to store electricity. The problem with the EVs is the batteries. They're the weak point. And so we can't get beyond the batteries. If you go to Toyota's website, they have a car that will run on that stuff. I'm sorry, our dog is barking. If you're hearing that, I apologize. But anyway, what I'm talking about here is that will be good. And I think the nuclear, there's some of these micro nuclear plants that literally are like the size of an 18-wheeler. And I think nuclear is going to be the right way to go. And I would like to address that. I was talking to a friend of mine who's a journalist in New York, and he said he did an interview with one of the folks that I've been watching. So I'm going to see if I can get some traction with those guys. Yeah, I mean, you got to get the materials for the batteries. That's the problem. It's not that there's not good batteries out there. It's making them and the deterioration of them. So I think probably the piston engine is still the best invention there has been. And there's a way, I'm still not convinced. I think EV is part of the solution, but I don't think it's the total solution, only because ultimately we're going to end up in competition between the AI, the server rooms versus the cars. Who gets the power? I'd rather go for intelligence than batteries. Just my thoughts on that. And that's why I think Toyota will actually win on that whole scenario. Okay, what do we got left? Let's take a look at gold and do Bitcoin, and I'll continue to kind of interact with some of the questions that you folks have going on here. We're a little bit over an hour. I usually like to keep this to an hour. So I will, let's go ahead and let's go to gold real quick. So gold continues to have a really positive configuration here. We saw this big spike up. We're finally seeing this angle of attack on gold is absolutely huge. Let's take a look. But we're getting at peak levels. The fact, by the way, just for those of you that have the indicators, is the fact that it's peaking out here doesn't mean that it's going to roll over. Now, we do have a potential V top, but all that tells us is that we probably come back. This is a monthly chart we're looking at, okay? So this is longer term. But what that means is that we're going to come into a consolidation phase. Also doesn't, the momentum is huge numbers right now. So we're not looking at a rollover just because of the indicators. So let's come down to earth a little bit and let's take a look at the weekly graph here. I forgot I'd set that on monthly. So now you can see the weekly is starting to flatten out. All the PPMs are starting to lose some momentum. This is probably, we actually hit all of the Fibonacci numbers that we talked about. So let me just bring this up here. Right now, the targets for the Fib numbers, Fib target 1 was 23.25, 24.50, and then 25.28, and we got up to 25.76 the other day. Bear with me 1 second, folks. Okay, folks, thanks for that. Yeah, so the gold does look like it's going to flatten out. The algos are suggesting a little bit of downside. Let's take a look at the daily chart real quick. They're starting to look a bit more negative here. So we've got an upward slope on the market grid. So we'll look for a really to stay within the grid. This PPM1 is still very positive at 0.12. So it's starting to fail. So I would look at a couple of days sideways and then probably some retracement. The intermediate charts continue to basically put us into a upward bias with a sideways thing, sideways pattern that's emerging. So, all right, let's let me come back up for a second here. We're about hour 10 into the stream. So let me come back up and let's do this. I'll look at a couple of questions here, and somebody just looking at a couple of things. I just saw, do we buy SPY puts? I would not. I would not buy. That's interesting. I think we got a bot here. Is there any Smurfs around? Because that's not me posting. And I can't log in at the moment and do that. Hang on, bear with me a second here. Yeah, I don't know who that link is, but don't click on that link there. So did it cover NVIDIA? No, I'll do NVIDIA before we go. Yeah, it's funny how 50 years ago we had the technology to go, but now we don't. Anyway, to the moon, that is. Anyway, the let's. I'm just looking at a couple questions here. Yeah, Tony, just take that that Kindle report is showing. Uh, that's that's not me. So just take them down if you can. Appreciate it. Yeah, you should be able to ban that. Okay. Yeah, so let's do NVIDIA and maybe look at Palantir. Let's do a couple stocks. We'll hang around for a few more minutes. This is a daily chart, and we still have, it's similar to looking how the markets do. We get this big spike low, the climactic low, and there's an argument here. I'll draw this in for probably one more wave up, maybe a retest of the highs. Take a look at this. I just noticed this little pattern in here. We've got maybe 1, 2. This is a wave 3. We could get something like this and maybe a new high. I see a spot up here. I'm gonna have to change the scale to see if that's a fib target. Actually, it is some kind of number up there, but this is most likely a pattern. These angle of attack here is this is a pretty bullish pattern that's setting up here. So let me bring up the PPM so we can get a look at that real quick. Yeah, so PPM's very robust, 2.04 right now. That's a huge number. Tells us that any move down to this is a daily down to the 10-day moving average is a screaming buy, and that would suggest we'd bounce off of that level. It's very solid support, but it does show us that we're going to start to lose momentum again. But that 10 SMA is going to be your key support here for a number of days. Yeah, Shytone, yeah, block that. Just block it. Yeah, if you haven't already. Oh, it's Mason. Don't block it. Okay. Hey, I just saw that. Don't block it. That's funny. All right. I think, wait a minute. I thought that was a bot. Took over. How funny. Good. That's funny. All right. What else was it somebody asked for? Oh, Palantir. Let's take a look here. This is another one that is, there was a time in space going back a while ago that I was talking about this. This is what I called one of the most dangerous stocks on Wall Street back in 22, something like that, maybe 23. Let me, let's go. But this thing has rebounded big, and we got buy signals. So, but if you look at this, it's kind of interesting because if you look at what's going on with Signal right now, some of these data companies, and it's very possible. I mean, these guys are government contractors, right, for the most part. But you can see we got this big outside bar that just came in. There's not a lot of data. This goes back. I remember when we were over here at around 26. I thought we were going to somewhere between 12 and 8, and we did. And we got a really nice buy signal on WaveTech back away. So we've been long this for a while. But it's very erratic, crazy volatility. This is sort of a meme stock as far as that goes. Okay. Yeah, thanks, Mace, for that. All right. Yeah, so let's get out of here. Let's go back to a daily. Yeah, so the move that would be back probably to around 29, close to your 28 number, whoever said that. We should pull back in there. If we break through the 10 period moving average, you should see a retracement there. You can see the algos are suggesting that there's a reasonable amount of, let me just try to get this situated up here, a reasonable amount of, of downside coming here. Close under that 10. Next level down would be down to 29 and potentially down to the 40, which would put us at that 28 number. We should see pretty solid support down in those levels. But we got a gap way down here on the big reversal off the lows back in August, so early August. So that was a big deal. This is yeah, this is sort of it's still kind of a meme stock. So you get the stampede and the swarm to show up on this stuff. That's very likely. Just looking at a couple. All right, just taking a look at some of these questions out here. All right. All right, I'll come back up and we're going to call this quit for tonight. It was a good stream. Appreciate everybody that showed up. I would just setting up just a couple closing things is if you don't have the indicators, get them, kendallreport.com/indicators and find out more about them. Kind of letting you know that we're working on a couple things to lower costs, so there's a better entry for folks that are on tight budgets. So we're working on that as well. We've had a lot of requests, a lot of folks talking about, that they just can't afford the indicators, and we've got them down. Oh, I did forget Bitcoin. Thank you. Let's do it real quick. But anyway, go there. Let's go to Bitcoin. Yeah, so let's Bitcoin, this is the daily chart. We got this blast up into the moving averages I discussed on the Substack on Thursday night for Friday. So we did get that move up, and we're consolidating here. It looks like we're going to trade back into these moving averages. I don't think this is the breakout. I did not mention these numbers the other day, but let me bring them up. There are some fib targets up here that popped up going back to August 19th, but those numbers are, I have talked about them in Substack. 68,290 is the min. That would be a retest of these highs, and then new highs being projected 74,300. I'm rounding off, in 77,690. Let's take a look at the weekly real quick, and then we'll call it quits. So weekly has a little more momentum. So when we look at the short term, we're looking at maybe some little backfilling into the moving averages, but this pattern here is still suggesting this is one of those moments that I talked about here, and I'm going to draw this in really quick, is we're looking at, you'll see right here the market grid expanded. So you'll see this big line coming up here, and then this is what I was telling you, it contracts, the same thing on the bottom. You'll see it move up into this pattern, and then once it contracts, then it'll try to make a move from there. what we've seen out of Bitcoin since the halving event is just noise. And this is like this scramble. And now what's being projected on a weekly basis is to come back up in here. The Fibonacci targets also come up in there as well. Yeah, so anyway, this has been the range that we've seen for a while. Yeah, this has been the range we've seen in this market for a while. Very choppy. Sell it 70 plus, buy it, let's say 55. The 50 we printed 49 on Extreme a couple of weeks ago, but this is really just locked in a range. I don't think we're about to make any kind of breakouts or anything of that sort. We could trade up into that 70 handle again. That's very possible. Okay, folks, this will be at hour and 20 minutes this time at night. Appreciate everybody hanging out. It's midnight Eastern time. So, but we still have the Substack coming out. So make sure you sign up for that. There is a free trial. And I think that's a must to have. I do put a lot of work into that. And I would ask those of you that are watching this, and if you get the Substack, I need to put I would like to know if all the sections I'm doing, like if you like my look back on yesterday's action or in last week, I'm I realized the other day that some of the stuff I'm putting out, I put out over 4,000 words on a daily newsletter, and it got pretty intense the other day. So, I would like to hone it back. I would just like to know the kind of stuff. So if you go in to the comments on Substack, that would be good. And I'll try to get out a survey of some sort here in the next several days. Anyway, folks, as always, thank you so much for watching. We'll sign out right now and appreciate everybody hanging out. It was cool to do it. Thanks.